What if I told you the most painful losses in trading don't come from being wrong, they come from being right? Think about it. You spot the setup, your analysis is on point, the market moves exactly how you predicted, and you're in profit. For a moment it feels like victory, you've done everything correctly, but then slowly, quietly, almost mockingly, the market takes it all back. And the trade that should have been your win, the proof of your growth, ends up leaving you with nothing but regret. That's the cruel irony of trading. You can be right and still lose. You can read the charts like a pro, you can time your entry perfectly, and yet one decision, or the lack of one, turns a green screen into a red nightmare. And deep down, it doesn't just hurt your account. It bruises your confidence, your belief in yourself. Because you don't just feel like you lost money, you feel like you wasted the opportunity that could have changed everything. And the worst part is, you replay it over and over in your head. You can still see the numbers on your screen, the profit that was once yours. You can still remember that little surge of excitement when you thought, this is it, I've cracked it. And now, instead of celebrating a win, you're left staring at a loss and wondering why you keep letting this happen. It's not that you don't know how to trade. You've studied. You've practiced. You've watched the charts for hours on end. You've seen patterns repeat. You've learned strategies, and you've even proven that your analysis can be right. But what kills you isn't the market moving against your analysis. It's your inability to protect what the market already gave you. That's the heartbreak of trading, not losing to bad analysis, but losing because you didn't lock in what was already yours. And here's the truth no one tells you when you start trading isn't just about finding the right entry. Anyone with enough screen time can find an entry. The real game, the real challenge is in managing the exit. It's in knowing how to hold when you should hold and how to protect when it's time to protect. That's where traders fall apart. Not in spotting the trade, but in keeping the reward. You see, the market has a way of testing your discipline. It doesn't just ask, can you predict direction? It asks, can you secure profit when it's in front of you? Can you resist the greed that whispers, just a little more? Can you silence the fear that says, what if I'm leaving money on the table? Because every time you hesitate, every time you say, I'll give it more room, the market finds a way to punish you, and you're left with the same sinking feeling, the same frustration, the same sick thought. If only I had protected it when I had the chance. Think about how many times this has happened to you. You're up big on a trade. Your account is glowing. You're already imagining what that win will do for your confidence, for your balance, maybe even for your life. And then it slips. And you don't just lose money, you lose that feeling of control. You lose that sense of progress. You lose a little more belief in yourself. And that cycle is deadly. Because when you don't protect your profits, you start to chase. You try to force the next trade to make back what you should have kept. You revenge trade. You over-leverage. You let emotions dictate your decisions. And soon you're not trading a plan. You're gambling with your future. But it doesn't have to be this way. Imagine if every time you were in profit, you knew, without a doubt, that you were walking away with something. Imagine if instead of fear, you felt certainty. Imagine if instead of greed, you felt control. Imagine the relief of never again letting a winning trade turn into a loser. That's exactly what the one-point stop-loss rule gives you. It's not a complicated formula. It's not some secret strategy only the top 1% know. It's simple, it's powerful, and it puts you back in control. Because the moment you're up by a certain amount, you lock it in. You secure your profit with a stop-loss that follows the price. And that single shift, that single habit, changes everything. The market will always move the way it wants. Sometimes it'll keep running in your favor. Sometimes it'll reverse in an instant. You can't control that. But with the one-point stop-loss rule, you control what matters: your profit. You make sure that when the market gives you money, you keep it. You stop letting green turn into red. You stop repeating the same painful cycle. You trade with discipline. And discipline is what makes winners. So here's the question: how many more times are you willing to watch profit disappear before you change the way you play this game? How many more gut punch losses do you need before you decide that enough is enough? Because the solution is here. It's simple. And once you apply it, you'll never trade the same way again. The first thing you need to understand is that trading is not about catching the biggest move on the chart. It's not about predicting the exact top or bottom. It's not about calling yourself a genius because you nailed an entry. Trading is about one thing and one thing only: keeping what the market gives you. Because the market is generous. Sometimes it hands you profit on a silver platter. But it's also cruel, And if you don't have the discipline to protect those gains, it will take them back without hesitation. That's why the 1-point stop-loss rule exists. It's not designed to make you rich overnight. It's not a hack or a shortcut. It's a simple rule that guarantees you never again watch a winning trade turn into a losing one. So what exactly is the 1-point stop-loss rule? At its core, it's straightforward. Once your trade moves in your favor by at least 1 full point, whether that's $1 in stocks, 10 pips in Forex, or 100 points in crypto, you immediately move your stop-loss to secure that profit. From that point on, no matter what the market does, you cannot lose on that trade. If the price keeps moving in your favor, your stop trails behind it, always 1 point behind. If the price reverses, your stop is hit, and you walk away with locked-in profit. It's like putting a safety net under your trade. You can climb higher and higher, and if you fall, you don't hit the ground. You land on the net and keep something for your effort. Now you might be thinking, that sounds too simple. How can 1 point make such a big difference? And that's the beauty of it. Simplicity in trading is powerful because complexity is where most traders fail. People overcomplicate their strategies, add dozens of indicators, and create rules so intricate they can't even follow them under pressure. But the 1-point stop-loss rule is crystal clear. It doesn't matter if you're trading Apple stock, the euro, or Bitcoin. The principle is the same. Once you're up, you lock it in. No hesitation, no excuses, no giving the market a chance to snatch it back. Think about the psychology of that. Right now, every time you take a trade, you're carrying a burden. Even when you're in profit, you're not relaxed. You're staring at the screen, second, guessing yourself, fighting greed on one side and fear on the other. Should I take it now? What if it goes higher? What if it reverses? That mental tug of war is exhausting, and it often leads to bad decisions. Sometimes you hold too long and lose everything. Sometimes you close too early and miss the move. Either way, you're never fully at peace. But when you apply the 1-point stop-loss rule, the pressure changes. You're no longer asking, will I lose this profit? Because you've already protected it. That thought alone transforms your trading psychology. It shifts you from fear and desperation to patience and control. You know that worst-case scenario, you're walking away green. That certainty is worth more than the money itself, because once you remove fear, you give yourself the ability to think clearly. You're no longer reacting emotionally. You're making decisions with logic and confidence. This is why I call it the easiest yet most powerful tool for profit protection. Because it doesn't require you to learn a new system, it doesn't force you to abandon your current strategy, and it doesn't demand advanced skills. All it requires is discipline, the discipline to say, once I'm up, I lock it in. It's a single adjustment that changes the entire game. Think of it like wearing a seatbelt. It doesn't stop you from driving fast. It doesn't limit your journey. But when something goes wrong, it saves you from disaster. And here's the thing, most traders underestimate how quickly profits can disappear. They think they'll always have time to react. But the market doesn't move slowly. It moves like lightning. A reversal can happen in seconds. News can break, liquidity can vanish, a big player can dump a position, and before you even click the mouse, your gain is gone. The 1-point stop-loss rule takes away that risk. It reacts for you. It protects you when you're not fast enough to protect yourself. It's like having a guard on duty at all times, making sure your profit never leaves unprotected. Now, I know some of you might be skeptical. You might be thinking, but what if I lock in 1 point, and then the trade keeps running? Won't I miss out on bigger profits? And here's where most traders get it wrong. The 1-point stop-loss rule doesn't limit your upside, it secures your downside. If the trade keeps running, your stop-loss keeps moving. You still capture the bigger move. But if the trade reverses, you've locked in something. In other words, you get the best of both worlds. You're always guaranteed a win, and you still have unlimited potential for more. Let's be honest, trading is already hard enough. Why make it harder by letting greed sabotage you? Every time you give back profit, you're teaching your brain the wrong lesson. You're reinforcing bad habits. You're telling yourself it's okay to be careless. And that's why so many traders stay stuck in the cycle of hope and regret. But when you apply this rule, you flip that script. You teach your brain discipline. You create a habit of protecting what's yours. And over time, those consistent small wins build into big results. That's how professional traders grow accounts. By protecting first and letting growth happen naturally. Here's my promise to you as we go deeper into this video. I'm going to show you real examples of how this rule works in different markets. I'm going to break down trades in stocks, Forex, and crypto so you can see exactly how it protects profit in real time. I'm also going to walk you through the psychology behind it, Why this simple habit has the power to rewire your brain, eliminate fear, and give you the confidence most traders never experience. Because once you understand the mechanics and the mindset, you'll realize this isn't just a trick. It's a foundation. It's the base layer of consistent trading success. I want you to imagine for a moment what your trading would feel like if you applied this starting today. No more watching green turn into red. No more regret-filled nights replaying what you should have done. No more roller coaster emotions. Just steady, consistent progress. Every time you step into the market, you know that if it goes your way, you'll walk away with something. That knowledge alone removes half the stress, and with less stress, you make better decisions. Better decisions lead to better results. It's a compounding effect, and it all begins with this one simple rule. The 1-point stop-loss rule is the difference between trading with fear and trading with confidence. It's the difference between gambling on hope and trading with discipline. It's the difference between staying stuck in the cycle of frustration and finally breaking into consistent growth. And here's the best part. It's not hard to apply. It doesn't require years of study or thousands of hours of screen time. It requires only one decision that from this moment forward, you will never again let the market take back profit you've already earned. By the end of this video, you're not just going to understand the 1-point stop-loss rule, you're going to feel it in your bones. You're going to see how it applies to your trades, how it reshapes your psychology, and how it transforms your results. And once you do, you'll realize that this simple habit is the missing piece that can take you from being a struggling trader to a confident one. Most traders don't blow up their accounts because they never win. They blow up their accounts because they win and then give it all back. It's the classic story: you enter a trade, you're in profit, and instead of taking what the market gave you, you hold. You tell yourself, just a little more, just one more candle, one more push. That tiny whisper of greed is what separates the winners from the losers. And here's the ugly truth. Greed almost always wins the argument. You see, the market has a way of feeding that greed. It gives you a little taste of profit, and you start imagining the possibilities. The $100 you just made suddenly looks like it could be 500, maybe even 1,000, if you just stay patient. Your brain starts projecting futures that don't exist yet, and in those daydreams, you're already spending money that isn't yours. That's where most traders fail, not on the entry but on the exit. They enter like professionals but exit like gamblers. And then comes the pain. Because more often than not, the moment you decide to hold just a little longer, the market reverses. Suddenly, your unrealized gain isn't gain anymore. It's shrinking, candle by candle. You watch the green fade to neutral, then to red, and your emotions swing violently. The excitement of winning turns into the panic of losing. You tell yourself it'll bounce back. You cling to hope. But the market doesn't care about your hope. It doesn't care about your feelings. It keeps moving against you until your trade is either stopped out at a painful loss or closed by you in frustration and despair. That cycle, hope, greed, regret, is what destroys accounts. And the worst part, it's addictive. Because every once in a while, by pure luck, that decision to hold does pay off. Maybe once in 10 times, the market actually keeps running in your favor, and you book a bigger profit. That one time keeps you chasing. It keeps you hooked. It convinces you that maybe next time, if you just hold again, it'll work. But more often than not, it doesn't. The house always wins, and in trading, the house is your undisciplined mind. Let's be brutally honest here. The reason most traders lose without the 1-point stop-loss rule isn't a lack of knowledge. You don't lose because you can't read charts. You don't lose because your strategy is broken. You lose because you refuse to protect what you've already earned. You refuse to draw a line in the sand and say, "This profit is mine. I will not give it back." Without that commitment, without that discipline, you're not trading, you're gambling. And gambling is an emotional game. 1 second you're high on the thrill of winning, the next you're crushed by the despair of losing. That roller coaster wrecks not only your account balance but also your psychology. You start doubting yourself. You hesitate on good setups. You over-leverage on bad ones. You revenge trade to make back what you lost. It becomes less about following your plan and more about chasing feelings. And the market punishes emotional traders every single time. Hope is the silent killer here. Hope whispers, "It'll come back. Don't close yet. Be patient." Hope is the reason you ignore the signs, the reason you sit frozen while the profit drains away. But in trading, hope is not a strategy. Hope is what keeps people stuck in losing trades until it's too late. Professional traders don't hope. They plan. They prepare. They accept the market's gift when it's offered. And they protect it like it's sacred. That's where discipline comes in. Discipline is the invisible wall between a profitable trader and a broke one. Discipline means you don't negotiate with the market. You don't wait for it to take back what you already earned. You don't let emotions run your account. And this is why the 1-point stop-loss rule matters so much, because it forces discipline on you. It takes away the option of, maybe I'll hold a little longer. It cuts through the noise of hope and greed with a simple, unbreakable line. Most traders lose without it because they're left defenseless. They're like soldiers on a battlefield with no armor, no shield. The market strikes, and they have nothing to absorb the blow. They tell themselves they'll be disciplined next time, they'll close earlier next time, they'll learn from this mistake. But without a concrete rule to protect them, they repeat the same behavior again and again, and every repeat cuts their account smaller and smaller until it's gone. Here's the truth you need to hear: the difference between consistently profitable traders and everyone else isn't strategy. It isn't indicators. It isn't luck. It's the discipline to protect profit. It's the ability to shut the door on emotions and say, enough. And that's exactly what the 1-point stop-loss rule gives you. A way to lock in gains before they vanish. A way to trade like a professional instead of a dreamer. Imagine this: you enter a trade, your analysis is solid, and the market starts moving in your favor. At this point, most traders lean back and smile. They think, finally, this is my win. But the truth is, this is where the real game begins. Because entering a trade is easy. Protecting your profit is where 90% of traders fail. That's why the 1-point stop-loss rule is so powerful. It gives you a simple, unbreakable method to make sure the market can't take back what it just gave you. Let's walk through it step by step. Step 1: your entry. You've spotted your setup, whether it's a breakout, a trend continuation, or a clean reversal. You place your trade at, let's say, 100. At this point, your stop loss is below your entry, protecting you from a complete reversal. For example, maybe your stop is at 99 to 50. So right now, if the trade goes against you, you'll lose 50 cents per share. Simple, straightforward. Step 2: the move. Price begins to climb. You're now at 100 The 100 bites 75 and then it touches 101. That's the moment that changes everything. Because here's the rule: once your trade is up by 1 full point, you immediately move your stop loss, not to break even, not to just below entry, but to 1 point above entry. In other words, your stop loss now locks in 101. If the market suddenly reverses, you don't just protect your capital, you walk away with profit guaranteed. You've made yourself bulletproof. Let's put it in numbers. Entry at 100, stop at 99.50, market moves to 101. You trail your stop up to 101. That means even if the market collapses right now, worst case scenario, you still exit with 100 profit per share. No stress, no regret, no emotional begging. The win is yours, period. Step 3: letting the trend do the work. The beauty of this rule is that it doesn't cut off your upside. If the market keeps running to 102, 104, your stop doesn't stay frozen. You trail it higher and higher. So maybe when the price hits 102, you move your stop to 102. When it hits 103, you move your stop to 103. Each time the market gives you more, you secure more. You're building a staircase of guaranteed profits, one level at a time. Now let's talk about scenarios, because this is where traders either master the rule or abandon it too soon. Scenario 1: sideways market. You enter at 100, the price moves up to 101, you shift your stop to 101. But then the market chops around, comes back, and takes you out at 101. Did you just lose? No, you won. You protected the dollar gain and walked away green, while everyone else who held on without protection gave their profit back to the chop. That's the point. This rule is designed to win in the ugliest conditions. Scenario 2: trending market. You enter at 100, it moves cleanly to 105. Each point higher, you trail your stop 1 point higher. So by the time it's at 105, your stop is at 105. No matter what happens, you're capturing the full move. If the trend keeps running, you ride it with zero fear. If it reverses, you cash out at the top of the move. That's how professionals stay calm in trending environments. They're not hoping, they're locking. Scenario 3: sudden reversal. This is where the rule really proves its power. Imagine you're in at 100, it moves to 101, you lock your stop at 101. Suddenly unexpected news drops and the price crashes to 98. Most traders panic, freeze, or take massive losses. You exit at 101 with profit already banked. No stress, no drama. That's the difference between surviving the markets and being crushed by them. This is the genius of the 1-point stop-loss rule. It transforms you from a hopeful gambler into a disciplined risk manager. You're no longer asking, will I win or lose? You're asking, how much of this win will I keep? That single shift in mindset changes everything. Now, let's address the psychology behind it, because this is where traders struggle. At first, Moving your stop to lock in profit feels counterintuitive. Your brain whispers, but what if it comes back down, stops me out, and then runs even higher? Won't I miss out? Yes, sometimes that will happen. Sometimes you'll be stopped out at +1, and the market will keep going without you. But here's the truth, missing out on additional gains is never as painful as watching profits vanish into losses. Regret from lost profits is sharp, but regret from avoidable losses is devastating. This rule exists to save you from that devastation. Think of it this way. Trading isn't about catching every last cent of every move. It's about staying alive, compounding steadily, and avoiding the emotional roller coaster. By locking profit at +1, you build confidence, discipline, and most importantly, consistency. And consistency is the only path to long-term success. Picture it like building a wall. Every time you lock in that +1, you're adding a brick to your fortress. Some days it's 1 brick, some days it's 10. But the wall grows stronger. Without this rule, you're not building a wall. You're stacking cards in the wind, and eventually it all blows away. Now, let's zoom out and see what this looks like over multiple trades. Imagine you take 10 trades. 7 of them hit +1 point, and you're stopped out with small but guaranteed profits. 2 of them trend massively, giving you 5, 6, maybe even 10 points. 1 trade reverses instantly, and you scratch with nothing. Add that up, and you're ahead. Steadily, predictably, without emotional chaos. That's the beauty of the rule. Charts make this crystal clear. Imagine a candlestick chart with your entry marked at the 100. The price climbs in stair-step fashion of 1.1, the 1.2, 103. Each level your stop trails higher to 101, then 102, then to 103. Finally, the market dips back and hits 103. You exit right there at the top of the move, not the bottom. You walk away smiling, while others ride the dip back to 100 and scratch their heads wondering what went wrong. This isn't about being smarter. It's about being prepared. It's about refusing to let the market control your outcome. The 1-point stop-loss rule puts you in control, not the other way around. And here's the part most traders don't realize. This isn't just a tool for profit protection. It's a tool for emotional protection. When you know you can't lose after being up 1 point, you trade with calmness. You're not sweating every tick. You're not glued to the screen in panic. You can let the trade breathe because no matter what, you're safe. That mental freedom alone is worth everything. So step by step, here's the process burned into your mind. Enter the trade with a clear setup. Once it moves 1 point in your favor, move your stop to fly 1 point above your entry. Keep trailing as the price advances. Protect the base, climb the staircase, and let the market do the heavy lifting. Sideways, trending, or reversing, you're covered. And over time, this habit turns you from a reckless dreamer into a disciplined professional. Trading is often described as a game of numbers, charts, and strategies. But the deeper you go, the more you realize it's really a game of psychology. It doesn't matter whether you're trading stocks, Forex, or crypto. The market finds a way to test your emotions in the exact same way. One day it feeds your confidence with quick profits, the next day it crushes your hopes by taking it all back. That cycle of greed and regret is universal across every ticker, every chart, every time zone. And that's exactly why the 1-point stop-loss rule is so powerful. It doesn't care if you're trading Tesla, EUR USD, or Bitcoin. The rule protects you everywhere. Let's walk through what this looks like across the major markets, and you'll see just how universal and life-changing it really is. Imagine you're trading Tesla. You've been watching the chart all morning, waiting for the breakout. The stock has been consolidating around 250, building pressure. You finally see the volume surge, the breakout candle forms, and you're in, entry at 250. The adrenaline kicks in immediately. For the first few seconds, nothing happens. The price wobbles around your entry, and you feel that old familiar fear creeping in. What if this breaks the other way? What if I'm wrong? But then, the Tesla jumps to the 250 wells in 251.25. Relief washes over you. You were right, the market's moving in your favor. Most traders stop thinking right here. They get hypnotized by the green numbers on their screen. They start calculating what their profit would look like if Tesla runs to 255, maybe even 260. They're already spending the money in their minds, already imagining, telling their friends about the perfect trade. And that's when the market loves to strike back, because that kind of thinking makes you vulnerable. You start to believe you deserve more, that the trade owes you more. But let's play this differently. At 251, you're already up 1 point. This is the trigger. You don't wait, you don't hope, you take action. You move your stop loss from its original position at 248 all the way up to 251. And in that moment, you've just transformed your trade. No matter what happens next, you cannot lose. The worst case scenario is walking away with $1 per share. That's your shield. That's your fortress. Now Tesla does what Tesla loves to do. It spikes up to 252, maybe 253. You're trailing your stop higher, moving it 1 point behind. You're calm, you're focused, you're protected. But suddenly, out of nowhere, a sell order floods the market. Tesla wicks down violently, slicing through support, and within seconds it's back at 251. The undisciplined trader, they're frozen, watching their green turn to red, holding on in disbelief as the breakout collapses. You're out at 251 with profit safely in your pocket. Same trade, same entry, same market, but two completely different outcomes. One trader is angry and shaken, the other is calm and secure. That's the power of discipline. Let's move to Apple. A slower mover than Tesla, but just as tricky. You see a clean setup around 175 and decide to buy. Price grinds up steadily to 186, then 177, you're in profit. Without the rule, you'd probably sit there thinking, let's see if it can run to 180. Just a little more. But we both know what usually happens. Apple stalls, reverses, and erases your gains. So instead you apply the rule. The moment you're up 1 point, you slide your stop to 186. You're safe. Apple climbs to 178, you trail to 178. It hits 179, you trail again. Suddenly a headline drops, bad earnings rumor, maybe. Apple reverses sharply, sellers flood in, price dumps back down. You're stopped out automatically at 179 with 4 points locked. While other traders are in chat rooms complaining about market manipulation and unfair reversals, you're sitting on a win. That's not luck. That's discipline. Now let's step into Forex. You go long EUR/USD at 1.800, anticipating a breakout on the European session. The pair nudges up slowly, then accelerates 1.0805, 1.08, 1.0810. 10 pips in profit. That's your 1 point equivalent. You move your stop up to 1.0810. Now you can breathe. You know you can't lose. And in Forex, where reversals can be vicious, that's a lifesaver. Price pushes to 1.0830, 1.830, 1.0840. You keep trailing higher, 1.820, then 1.0830. Suddenly, US news hits. The dollar spikes, EUR to USD crashes straight back down. Traders who didn't lock profit, they watch their gains evaporate, maybe even take a loss. You exit at 1.0830, banking 30 pips. That's the difference between gambling and trading. Now think about GBP/JPY, the beast. It's volatile, unforgiving, and moves like a runaway train. You enter long at 195 ordered. Within minutes it surges to 186 ordered. That's your signal. You move your stop to 186.5 ordered, locking in 100 pips. You're protected. Then, as this pair often does, it rips higher, 186.50, 187 ordered, 187.50. Each level you trail your stop up. At 187.50 you're locked in 250 pips. Suddenly, the pair does what it's famous for. It crashes. A 150 pip red candle wipes out half the move. Traders without protection see their profits vanish in seconds. You're out at 187.50, calm, secure, smiling. That's the difference this simple rule makes. And now to crypto, the wild west of trading. Bitcoin at 40,000 you buy. It spikes to the 41,000 and instantly you move your stop up to 41,000. You go to sleep knowing that even if Bitcoin crashes, you're green. Hours later, Bitcoin surges to 43,000, 44,000. Each thousand higher, you trail your stop. At 44,000, your stop is locked. And then, like clockwork, Bitcoin does what it always does. It dumps. A 2,000 red candle wipes out over-leveraged traders in minutes. Twitter explodes with panic. But you're already out at 44,000. Profit secured, sleeping soundly. Ethereum plays the same game. Entry at 2,000, rally to 12,050. You lock your stop. Price runs to 2,200. You trail it up. Then the reversal hits, crashing back to 2,100 done. You're stopped out at the top. Did you catch the entire move? No. But you captured enough, and you protected it flawlessly. Traders who held just a little longer are now bag holding, praying for recovery. Your banking wins, ready for the next opportunity. This is the beauty of the 1 point stop loss rule. It doesn't just protect you in one market, it protects you in all of them. Stocks, Forex, crypto. The charts look different, the tickers sound different, but the psychology is identical. The moment you're up 1 point, you move your stop, and suddenly the game changes. You're no longer asking, will I win or lose? You're asking, how much of this win will I keep? That mindset shift is universal. Here's the deeper truth. Markets don't beat traders. Emotions beat traders. Hope, greed, fear, they're the same whether you're trading Tesla at 9:30 a.m. EUR/USD at London Open or Bitcoin on a Sunday night. The 1 point stop loss rule isn't just a trading technique, it's an antidote to emotion. It forces you to act with discipline, no matter what market you're in. And once you see this rule working across markets, your confidence changes forever. You stop second guessing yourself. You stop feeling like you're cursed when profits disappear. You stop panicking at reversals, because you know you're safe. You know you've built a shield around your capital. You know you're trading like a professional, not a gambler. So whether you're holding Apple into earnings, scalping EUR/USD, or swinging Bitcoin on the weekend, remember this: the charts will always test you, The market will always tempt you, but discipline beats temptation. One point of protection is all it takes to shift the balance from chaos to control. Apply the rule everywhere. Protect your wins everywhere, and you'll start to see trading not as a gamble, but as a game you can finally win consistently. There's one truth about traders that most people never admit out loud. We absolutely hate giving money back to the market. The pain of watching hard-earned profit vanish is often worse than taking a straight loss. Why? Because when you lose from the start, your mind says, okay, maybe I was wrong. But when you were already green, when you already had the win in your hand, and then you give it back, that feels like betrayal. It feels like the market stole from you, and that pain cuts deeper than almost anything else. This is the psychology that destroys traders. The chart moves in your favor, you see green on your screen, your heart lifts, your confidence soars. For a few moments you feel unstoppable. Then, without warning, the market reverses. The green shrinks, then disappears, then turns red. You sit frozen, hoping it comes back, watching it slip further. By the time you accept the loss, you've not only lost money, you've lost trust in yourself. And that broken trust is why so many traders spiral. The one-point stop-loss rule exists to end that cycle. It's not just about locking in profit. It's about training your brain to stop fearing the market, to stop clinging, to stop hoping. Because hope is the silent killer in trading. Hope tells you, it'll come back, just wait. Discipline tells you, protect what's yours. When you apply this rule, you stop fighting the market and start protecting yourself. That single shift changes everything. Think about the emotional battle that plays out inside every trader's head. On one side, there's fear of losing, fear of being wrong, fear of missing out. On the other side, there's greed, the hunger for more, the dream of catching the big move, the voice that whispers, don't sell yet, it might double. These two forces pull at you every single trade. That's why trading feels exhausting. It's not the market that wears you down, it's the constant tug of war in your mind. The one-point stop-loss rule is like a referee in that fight. It ends the chaos. Once you're up 1 point, the decision is made, you protect the trade. No debate, no second guessing, no battle between fear and greed. You've set a new baseline, your worst case is winning. Suddenly your brain relaxes. Fear quiets down, greed loses power, and discipline takes control. At first this feels strange. You'll hear that greedy voice in your head. Why sell so early? Why move the stop so fast? What if it keeps going? But here's the thing. You're not limiting your upside. You're securing your downside. If it keeps going, you trail your stop and capture more. If it doesn't, you walk away green. Either way you win. That's not weakness. That's strength. That's how professionals think. Let's look at what this does for your psychology over time. Imagine two traders. Trader A wins big sometimes, but gives a lot back. They're up 500 one day, then down 700 the next. Their equity curve looks like a roller coaster. Emotionally, they're drained. Confidence shattered. Trader B applies the one-point stop-loss rule. They don't hit massive home runs every time, but their equity curve rises steadily. They stack small wins. They build consistency. Emotionally, they feel calm, in control, confident. Who lasts longer? Who grows? Always Trader B. And this brings us to the most important truth. Small wins are the foundation of big success. Most traders chase jackpots. They dream of doubling their account overnight. But the traders who survive, the ones who thrive, understand that growth comes from stacking small, safe wins over and over, for years. The one-point stop-loss rule is your training ground for that mindset. Every time you lock a profit, no matter how small, you're rewiring your brain. You're teaching yourself, I protect what's mine. I don't gamble. I don't hope. I trade with discipline. Over weeks, that lesson compounds. Your confidence grows. You stop fearing the market because you know you have a system to protect yourself. You stop feeling desperate because you're not bleeding away wins anymore. You start to view trading as a game of survival and compounding, not a lottery ticket. That shift in psychology is the difference between amateurs and professionals. Think of it like building a muscle. Every time you apply the rule, you strengthen the discipline muscle in your brain. At first, it feels uncomfortable, just like going to the gym. But the more you do it, the stronger you get. Soon, discipline becomes your default. And once discipline is your default, trading becomes so much easier. You're no longer at the mercy of emotion. You're in control. There's another layer to this. Protecting profits doesn't just save money, it saves mental energy. Losing money you already had drains your spirit. It makes you bitter, impatient, reckless. But locking in profit, even small, fuels your spirit. It gives you momentum, optimism, and patience. Instead of feeling like the market is your enemy, you start to feel like you can work with it. That positivity compounds, and suddenly, Trading isn't a source of stress, it's a source of confidence. Now let's talk about growth. Protecting profits today doesn't just help you this week. It sets you up for the future. Think about compound interest. If you stack small, consistent wins, your account grows steadily. You may not notice it day to day, but month after month, year after year, the growth is undeniable. Traders who gamble might hit a big win once in a while, but then they lose it. They never build real wealth. But the disciplined trader, they grow like a snowball rolling downhill, slow at first, then unstoppable. This is why the 1-point stop-loss rule is more than just a tactic, it's a mindset shift. It trains you to think long-term, to respect the power of small wins, to see trading as a marathon, not a sprint. And the traders who embrace this psychology don't just make money, they last. They're still here when others burn out. They build confidence, resilience, and ultimately, freedom. So the next time you feel that rush of being green on a trade, remember this: the money is not yours until you protect it. The market can take it back in an instant. Don't let it. Train your mind to act with discipline, not emotion. Lock in that first point. Protect what's yours. Because once you do, something amazing happens. You stop trading scared, and you start trading free. And that's the real psychology of protecting profits. It's not about being cautious. It's not about being weak. It's about taking control. It's about ending the emotional roller coaster. It's about stacking small wins until they turn into big ones. And it's about becoming the kind of trader who doesn't just survive the market, but thrives in it year after year. Every trading rule is only as strong as the trader following it. And the truth is, most traders find ways to sabotage even the simplest systems. The 1-point stop-loss rule is designed to protect you. It's a shield. But if you misuse it, ignore it, or twist it, it can turn from your greatest ally into another excuse for bad habits. Let's break down the biggest mistakes traders make with this rule. If you recognize yourself in any of these, don't panic. It's normal. But it's also the signal that you need to grow. Because once you stop making these errors, this rule becomes unstoppable. Mistake 1: moving stops too early. This one comes from fear. Imagine you buy Tesla at $250 and within seconds, it ticks up to $250. You panic, move your stop to the $250, and pat yourself on the back for locking in profit. But the market breathes, it dips back to the $250.40, tags you out, then rockets to $255 without you. What happened? You cut yourself out of a winner. Why? Because you confused the natural noise of the market with a threat. You didn't give the trade space to work. This is the danger of moving stops too soon. You turn the rule into a straitjacket. Instead of giving your trade the oxygen it needs, you choke it out. The whole point of the 1-point stop-loss rule is to wait until you have a meaningful cushion. Once you're up a full point, then you move the stop. Not half a point, not 3/4, 1 full point. Because at that stage, you've earned the right to protect profit without killing potential. Discipline is not about being scared, it's about being precise. Mistake 5: moving stops too wide. On the opposite side of fear is greed. Some traders say, 1 point isn't enough, I'll move my stop once I'm up 3 points. They convince themselves they're being smart, letting the trade breathe, giving it room. But what's really happening? They're bending the rule to satisfy greed. They don't want to secure a small win. They want to swing for the fences. Here's the problem: markets reverse quickly. If you wait too long to adjust your stop, you risk giving back your entire gain. By the time you decide to protect, the move is already gone. And then you're left with the bitter taste of regret. I should have locked in earlier. That's why the rule is 1 point, not 3, not 5, not 10. It's consistent, universal, and unemotional. The moment you start stretching it, you're no longer following the rule, you're following greed. Mistake 3: not respecting the system. This one is subtle but deadly. Many traders love the rule when it works for them. They brag about how it locked in profits, how it saved them from a reversal. But the moment the rule costs them a big run, they abandon it. They say, if I hadn't used the rule, I would have made so much more. And that thought is poison. Because once you start cherry-picking when to follow your system, you don't have a system anymore. You have randomness. Trading is not about one trade. It's not about one day. It's about thousands of trades over years. The 1-point stop-loss rule isn't designed to catch every monster move. It's designed to protect you from ruin and build consistency. If you only respect it when it feels convenient, you'll never get its full power. True discipline is obeying your system even when it feels uncomfortable, especially then. Mistake 4: over trading because of false confidence. This is the silent trap of success. Once traders experience the safety of the rule, they feel invincible. I can't lose anymore, they tell themselves. Even if the trade fails, I'm green. And that false confidence leads to overtrading. Suddenly, they're taking setups they'd normally skip. They're forcing trades, chasing moves, clicking buttons just to feel alive. The result: death by 1,000 cuts. Yes, the rule protects them from big losses, but the spread commissions and small failed trades pile up. They bleed slowly, not from one big wound, but from dozens of tiny scratches. The rule was never meant to replace discipline in choosing trades. It was meant to enhance it. You still need patience. You still need setups. The 1-point stop-loss rule is not a license to trade recklessly. It's a safety net for when you trade smart. Now, let's take a closer look at the psychology behind each mistake. Moving stops too early comes from fear of missing out on profit. You don't trust the market, and worse, you don't trust yourself. You think, if I don't grab it now, I'll lose it all? That fear makes you cut winners short. The cure: trust the system. Train yourself to wait for that full point before adjusting. Every time you resist the urge to move early, you grow stronger. Moving stops too wide comes from greed. It's the belief that small wins aren't enough. You want more faster, but greed blinds you to the reality that steady small wins compound into massive growth. The cure: respect the 1-point rule. Remember that 1 point is not about the money. It's about building discipline. The money comes later, as a side effect of consistency. Not respecting the system comes from ego. You want to feel smarter than the rule. You want to believe you can outthink the market. But the truth is, no one outsmarts the market, not for long. The cure: humility. Commit to the rule, not because it feels perfect, but because it keeps you consistent. Consistency beats brilliance over time. Overtrading comes from overconfidence. You start to believe you've solved trading. But trading is never solved. It's a lifelong battle with probability, emotion, and discipline. The cure: restraint. Use the rule as a tool, not a toy. Combine it with strict trade selection. One good trade protected by this rule is worth more than 10 sloppy trades that chip away at your account. Let me paint 2 trader profiles for you. Trader A moves stops too early. They constantly get stopped out on noise, then watch the market run without them. Frustrated, they stop believing in the rule. They tweak it, break it, abandon it. Their results are inconsistent, their psychology fragile. Trader B follows the rule exactly. They wait for 1 point, then move their stop. They don't stretch it, they don't rush it. Over time, their results stabilize. They may not hit every home run, but they protect every base hit. And in baseball, it's the steady hitters who build careers, not the ones swinging for the fences every time. The difference between these traders isn't intelligence. It isn't skill. It's respect for the rule. One bends it to fit their emotions. The other bends their emotions to fit the rule. Guess which one wins? And here's the deeper truth: every mistake you make with this rule is really a mirror. Moving stops too early, that's your fear showing. Moving them too wide, that's your greed. Ignoring the system, that's your ego. Overtrading, that's your impatience. The rule itself is simple. The mistakes you make with it reveal who you are as a trader. If you study those mistakes honestly, you'll discover exactly what's holding you back. That's the hidden gift of this rule. It's not just about profit protection. It's about self-discovery. Every time you misuse it, you're being shown a weakness in your mindset. And every time you correct it, you're building strength. Over months, those corrections compound. You don't just grow as a trader, you grow as a person. So let's end with a challenge. For the next 30 days, commit to the 1-point stop-loss rule. Follow it without exception. Notice when you're tempted to move stops too early, too wide, or ignore the system. Notice when you feel the urge to overtrade. Instead of judging yourself, study it. Ask, what emotion is driving me right now? Then choose discipline. Choose the rule. Protect your profit. Because in the end, trading isn't about beating the market. It's about beating yourself. The market doesn't care if you win or lose. But you care. Your future depends on it. And if you can master yourself through something as simple as the 1-point stop-loss rule, then no mistake, not fear, not greed, not ego, not overconfidence can stop you. Every trading strategy sounds good in theory. Every rule feels powerful when you first hear it. But trading isn't about theory, it's about proof. What works on paper doesn't always work in the heat of the market. That's why professionals don't just rely on faith. They backtest. They collect data. They run the numbers to see what holds up over thousands of trades, across markets, through good days and bad. So let's ask the hard question: does the 1-point stop-loss rule actually improve results? The short answer: yes. And the long answer: let's dig into the data. Backtesting example 1. Seen the raw win rate shift. Imagine you take 100 trades on a stock like Apple without the rule. You set a loose stop, you hold, you hope. Out of those 100 trades, maybe 40 end green, 60 end red. Your win rate is 40%. Not terrible but not great. The problem: even the green trades fluctuate. Half of them went green, then back to red before you closed. You let the market decide instead of you. Now backtest the same 100 trades but apply the 1-point stop-loss rule. What happens? Every time you hit that first point, you shift your stop and guarantee profit. Out of 100 trades you still lose some, but suddenly 40 wins become 65. Why? Because many trades that would have reversed to break-even or small losses are now locked as wins. Your win rate doesn't just improve, it transforms. It's not magic, it's math. By removing break-even reversals, you increase your percentage of green trades. That higher frequency of wins fuels consistency, and consistency fuels growth. Backtesting example 2Z. Risk to reward ratios. Let's say your average risk per trade is 200, targeting 400. Without the rule, you get stopped out fully half the time, and the other half you sometimes give back gains. Your actual average reward ends up closer to 250. Over 50 trades, your net might be break even, maybe slightly positive. With the 1-point stop-loss rule, things change. Because every time you lock in that 1 point, your worst case flips. Instead of full 200 losses, many trades stop out with FOV 100 or 200. Instead of wins turning into losses, they stay wins. Suddenly, your risk to reward shifts. You're no longer risking 200 to maybe make 400. You're risking 200, but half the time you're guaranteeing 100 profit. That changes the math of your system forever. Over 50 trades, that small shift compounds. Instead of breaking even, you're stacking consistent green, and your equity curve smooths out. That's the proof discipline makes your numbers work in your favor. Case study 1. The undisciplined trader. Meet Alex. He trades futures, smart guy, knows technical analysis. He calls setups well, but his results, all over the place. He's up 2,000 one week, down 3,000 the next. He has a bad habit of letting green trades turn red. Backtesting his journal, we see the patterns. 60% of his trades went green at one point, but half of those flipped negative because he didn't protect. His win rate looks like 35%, his equity curve jagged. He feels like the market's enemy. Case study 20. The disciplined trader. Now meet Sarah. Same markets, similar setups. But Sarah applies the 1-point stop-loss rule religiously. She backtests her trades and discovers something fascinating. Trades that used to fail now finish green. Out of 100 trades, she's profitable on 70. She rarely hits monster gains, but she's rarely red. Her equity curve climbs steadily, slow but consistent. More importantly, her psychology stabilizes. She's no longer drained by emotional swings. Her discipline is paying her, trade after trade. The difference between Alex and Sarah isn't knowledge, it's discipline. And that's exactly what backtesting proves. Case study 30. Crypto application. Let's run this in Bitcoin. You backtest 200 trades on a simple breakout strategy without the rule. You get 90 wins, 110 losses. The problem: many of those losses started as green. Your win rate 45%, equity curve choppy, inconsistent. Now apply the 1-point stop-loss rule. Every time BTC goes your way by 500, you lock it. Suddenly, 90 wins becomes 140. Your win rate jumps to 70%. Even better, your average loss shrinks because many failed trades still close green. Your account doesn't just survive, it grows. That's the beauty of universal rules. They work in every market: stocks, Forex, crypto, futures. Backtesting confirms the principle: if you protect early, you survive long enough to thrive. The psychology in backtesting, but here's something even more important than the numbers: the mindset shift. When you backtest the 1-point stop-loss rule, you're not just proving the math, you're proving to yourself that discipline works. You see it in black and white. You see the equity curve. You see the improvement. And that evidence builds belief. Once you believe in a rule, you're far more likely to follow it live. This is why professionals backtest everything. It's not just about optimizing strategies. It's about programming the mind. When you've seen thousands of data points proving a rule, your brain stops fighting it. You no longer wonder, should I move my stop? You know the answer. You've seen the proof. Risk to reward over time. Here's what the numbers show. Without the rule, your average risk to reward might be 101.2, barely enough to beat commissions and spreads. With the rule, your effective risk to reward shifts to 1.5 or 1e2. Why? Because you're reducing the size of your losers and increasing the frequency of winners. Even if your big winners don't change, your small winners multiply. Over thousands of trades, that math is unbeatable. Let me give you an analogy. Imagine two farmers. One plants seeds and hopes for rain. Sometimes his crops thrive, sometimes they die, and his harvest is unpredictable. The other farmer builds irrigation. He still plants seeds, but now he guarantees water. His crops aren't always massive, but they're consistent. Over years, his harvest builds wealth. That's the 1-point stop-loss rule. It's irrigation for your trading. It doesn't rely on luck. It creates consistency. Backtesting across timeframes. Here's another insight: backtests show the rule works on multiple timeframes. On 5-minute intraday charts, it protects scalpers from reversals. On daily charts, it protects swing traders from overnight gaps. On weekly charts, it protects investors from long-term corrections. The percentage gain per trade changes, but the principle doesn't. Protect profit once you're up. That's timeless. Final proof: the equity curve. At the end of every backtest, the most important picture is the equity curve. Without the rule, it's jagged, sharp peaks and valleys, emotionally draining. With the rule, it's smoother, consistent, steadily rising. That curve is more than data, it's confidence. It's proof that discipline pays. It's the visual reminder that protecting profit isn't just smart, it's the only way to build long-term wealth. So here's the bottom line: backtesting proves what psychology predicts. The 1-point stop-loss rule improves win rates, stabilizes equity curves, strengthens risk to reward, and calms the trader's mind. Those aren't opinions, they're numbers, and numbers don't lie. If you're still skeptical, do it yourself. Pull up your trading journal. Run the last 50 trades with and without the rule. Count how many greens would have stayed green if you protected at 1 point. See how many reds would have been avoided. Watch how your win rate changes. Once you see it with your own data, you'll never question the rule again. Because here's the ultimate truth: traders don't blow up from bad setups, they blow up from not protecting profits. The 1-point stop-loss rule fixes that. Backtesting proves it. And now the only question left is, will you respect it? When you first learn the 1-point stop-loss rule, it feels like discovering a secret: protect the first point of profit, and you stop letting winners turn into losers. But mastery comes when you take that simple rule and adapt it to real markets, real volatility, and real human behavior. The rule is a foundation, not a cage. Once you understand how to scale positions, use trailing stops and true trends, combine the rule with sensible indicators, and adjust what 1 point means for different assets, you move from disciplined beginner to adaptable professional. Let me walk you through how to do that in a way that's practical, repeatable, and psychologically sane. First, think in terms of fractions and stages instead of all in or all out. Scaling out is the bridge between safety and opportunity. Instead of closing a whole position when you hit your first point, you can lock some profit and let the rest run. A typical scalable approach could look like this: enter with 3 units, take 1 unit off at +1 point to lock a guaranteed chunk of profit, move your stop to break-even or to that +1 point for the remaining units, then let the last unit ride with a trailing stop. Doing this accomplishes 2 things. It secures cash in hand immediately so you don't feel desperate, and it gives you the psychological freedom to let the remaining size capture a larger move without the weight of the whole position still at risk. Think of it as planting stakes on a mountainside. Every stake you hammer in makes the next stretch safer. Over many trades, this method smooths the equity curve and reduces stress because you're not relying solely on one outcome to make the session profitable. Now pair scaling with the rule's core the moment you get that first point. Reduce exposure and raise your protective stop. Don't be dogmatic about exact percentages. Test 25 or 33 and see which matches your edges and commissions. The underlying principle remains the same: lock something early, let something run. Next, understand how to use trailing stops in genuine trending markets. The 1-point stop loss is brilliant for protecting early gains, but trends offer the chance to compound winners. A trailing stop lets you ride the wave while maintaining protection. The simplest trailing method is fixed step trailing. Every additional point the market moves in your favor, you step your stop up by 1. If you prefer structure-based trailing, trail your stop just below the last meaningful swing low in an uptrend or above the last swing high in a downtrend. The advantage of structure-based trailing is it respects market geometry. Pullbacks and consolidation are allowed, but a change in structure equals an exit. In practice, that looks like this: you enter, the trade moves to 1 and your stop moves to secure profit, price continues and prints a higher low, you move your stop to just below that higher low, price makes another run, repeat. This method captures sizable runs without sacrificing the discipline of locking early gains. For very strong trends, combine trailing with scaling. Reduce size at the first point, trail the rest on structure, and let the trend compound your winners. A common beginner mistake is to choose between locking early and letting winners run. The advanced trader does both: lock early, then trail intelligently. Volatility matters. This brings us to one of the most practical refinements: pairing the 1-point rule with volatility measures like ATR's average true range. ATR tells you how far a market typically moves in a given time frame. If ATR is high, a rigid 1 point can be too tight, you'll get stopped out by normal noise. If ATR is low, 1 point may be too generous or unnecessary. Use ATR to scale the point size dynamically. For example, on a market with an ATR of 20 ticks, A point could be 1/5 to 5/10 of ATR depending on your time frame and edge. On a market with ATR of 100 ticks, scale up accordingly. This keeps your rule meaningful across assets and time frames rather than arbitrarily rigid. Another powerful combo is using moving averages or momentum indicators to choose your protection aggressiveness. If price is above an expanding moving average and momentum is strong, give the trade more room before tightening to 1 point. Allow the trend to breathe. If price is chopping around an EMA and momentum is neutral, be aggressive and lock the first point quickly. Momentum indicators like RSI or MACD can signal whether a move has strength. Combine that signal with the 1-point lock to avoid being stopped by harmless pullbacks inside a strong trend. Here's how that looks practically. You enter a trade and you're up 1 point. If RSI is rising and MEC shows expanding histogram, consider locking partial size and setting the stop for the remainder at +1, but plan to trail to a higher level only when the next structural pullback holds. If indicators show fading momentum, take more off at the first point and move the stop immediately. Don't get greedy. Markets rarely provide perfect certainty. Indicators simply tilt the odds in your favor. One of the cleanest technical setups I've seen is to combine ATR-based sizing with a short-term moving average. When price is above the 20 EMA and ATR is low, your point can be the base 1 unit. When ATR spikes, increase the point to 1.5x or 2x ATR to avoid noise. Never make the point purely emotional. Let volatility and structure guide you. Adjusting the point across markets is critical. 1 point in the S&P 500 ES is not the same as 1 pip in EUR/USD or $1 in Bitcoin. When people hear 1 point, they often lock onto the phrase literally and lose performance. Instead, think in relative terms. The point is the first meaningful milestone the market reaches that confirms the trade is real. For Forex, that might be 10 pips on a scalp. For equities, it might be 0.50 to 100 depending on stock's liquidity. For futures, it might be the exchange's tick unit multiplied to reflect noise. The practical way to set your benchmark is to measure typical swing sizes with ATR and set the point as a fraction of ATR. This is how you keep the concept universal and robust. Next, guard against the human traps that destroy advanced rules: moving stops too early, moving them too wide, or using the rule as an excuse to overtrade. The rule's elegance is in its discipline, but humans will always test discipline. If you move stops too early, locking at half a point for example, you simply hand winners back to the market and create a data stream that looks like constant whipsaws. If you move them too wide, you negate the rule and return to the old habit of giving back gains. The remedy is stubborn consistency. Define the exact conditions when you move the stop, the OG, the candle that reaches the point close, not wick, and enforce that rule mechanically for a trial period. Use automation where possible. Use your platform to place the stop immediately when the rule fires. That takes the emotional throttle out of your hands. Another advanced tactic is profit partitioning. After the first point, transfer a fixed percentage of profits into a separate, low volatility account or transfer the proceeds to a safer asset. This is behavioral engineering. Once profits are physically segregated, your risk-taking brain cannot easily re-expose them to the market. Scaling, trailing indicators, and partitioning are not separate strategies. They are modular tools that work together. Use them in concert rather than in isolation. For example, you might scale out 33% at fly once a locking profit. Move your stop to break-even for the remaining 67%, and then trail that remainder using a 1.5x ATR-based trailing stop while confirming continuation with a 20 EMA and momentum readings. That multi-layered approach minimizes whipsaw risk while maximizing capture in trends. Execution matters. Your platform and order routing need to be fast and predictable. If you're trying to implement partial exits and dynamic stops manually in a fast market, latency will kill you. Use bracket orders, automated OCO1 cancels other instructions, or a simple algo if your platform supports it. Many pro traders pre-program the sequence: first partial exit at point, stop adjustment, trailing logic, final exit. This way human hesitation doesn't undo your plan. Money management remains the final pillar. The 1-point stop loss rule changes your distribution of outcomes but doesn't eliminate risk. Keep position sizes in check so that a normal string of losing trades, inevitable in any system, doesn't blow your account. Because one risk of success with the rule is false confidence. You might think you're invincible and ramp up size. Don't. Maintain strict risk limits and let the rule earn you compounding gains slowly and steadily. Finally, test everything on your own data. These advanced adjustments, scaling percentages, ATR multiples, indicator combos, are not one size fits all. Backtest, forward test on a demo, then scale. The point of sophistication is not to create complexity for its own sake, but to preserve the core advantage, protecting early gains while capturing trends. If you keep that purpose central, Every tweak you make should be judged by two questions: does it increase the proportion of protected winners, and does it reduce emotional friction in execution? If the answer to both is yes, it's worth trying. In the end, the 1-point stop-loss rule is a philosophy: protect first, then pursue growth. Advanced traders know that you don't abandon simplicity for complexity, you refine simplicity so it survives real-world markets. Use scaling to lock and let run, use trailing and structure to ride trends, use indicators and ATR to adapt to volatility, and keep money management strict. When you combine those elements into one clean, disciplined process, you'll trade with more calm, capture more winners, and sleep knowing your profits are not vulnerable to impulse or noise. That's the final payoff of mastering the rule: psychological freedom and sustained compounding. Most traders finish a video like this and nod along, thinking, yes, that makes sense, I should do that. But then the next time they sit down in front of the screen, nothing changes. The same habits creep back in, the same mistakes repeat, and the cycle continues. That's why we need more than theory. We need a clear action plan, something so simple and direct that you can apply it immediately, trade after trade, until it becomes automatic. Let's turn the 1-point stop-loss rule into a daily routine that keeps you disciplined, keeps you protected, and ultimately keeps you profitable. The very first step is mindset. Before you even look at a chart, remind yourself of this truth: the market doesn't owe you anything, but it constantly offers opportunities. Your job isn't to squeeze every last drop out of a move. It's to protect what you're given. Say this to yourself before your trading day begins: I will protect profit first, and let growth come second. That simple affirmation rewires your approach. Instead of trading like a gambler hoping for a jackpot, you trade like a professional whose first goal is survival and consistency. Without this mental reset, no checklist will matter, because discipline always begins with belief. Now let's get tactical. The action plan begins with your entry. Whether you're trading stocks, Forex, or crypto, your entry point is the baseline. Place the trade exactly as your system tells you. No hesitation, no second guessing. The key is what happens after. Once price begins to move in your favor, you shift into protection mode. Here's the golden sequence: entry, profit, stop, shift. If price moves 1 point in your direction, your first move is automatic: adjust your stop loss so that if the market reverses, you still walk away with a gain. This step cannot be skipped. You don't wait to see if it runs further. You don't argue with yourself about whether it's too early. You do it immediately, like a reflex. Think about how pilots train. In an emergency, they don't stop to debate, they follow the checklist that's been drilled into them. That's how you must treat this rule: a checklist-driven reflex. The moment you're up 1 point, move the stop, every single time, no exceptions. That's how habits are built, through strict repetition. Here's a sample checklist you can keep by your desk. Did I enter according to my setup rules? Is my stop loss in place before the trade begins? Has the trade moved 1 point in my favor? Did I immediately move my stop to protect that profit? Am I following my plan for scaling or trailing if conditions allow? Did I avoid second guessing or moving stops without reason? You can print this, write it on a sticky note, or tape it to your monitor. The point is to anchor your behavior in a system, not in your emotions. Because when the candles are flying and the numbers are flashing, your brain will try to bargain with you. It will whisper, wait just a little longer before you move the stop. Give it some room. That's how traders slip. The checklist kills that voice by replacing it with a simple binary question: did I move the stop or not? Next comes the routine for discipline. One powerful way to train is to journal every single trade with a rule compliance note. Don't just record entry, exit, and P&L. Record whether you applied the 1-point stop-loss rule without hesitation. If you didn't write down why, over a week or two, you'll see patterns. Maybe you're compliant in the morning but sloppy in the afternoon. Maybe you're strict with small size but loose with larger size. These insights are worth more than any strategy tweak because they reveal your psychological weak spots. With that awareness, you can target the exact moments you need to reinforce discipline. Another practice is simulation. Before the trading day begins, load up past charts or use a replay feature on your platform. Walk through trades in fast, forward, and practice the sequence: enter. Price moves 1 point, stop shifts. Do this 10 or 20 times in a row. It's not about making fake money. It's about drilling the habit so deeply that when real money is on the line, you don't hesitate. Athletes train muscle memory before game day. Traders must train stop-loss memory before live sessions. Here's a practical day plan before market open. Spend 10 minutes reviewing your setups and affirming your profit protection mindset. During trading hours, apply the checklist on every trade. After trading hours, spend 15 minutes journaling your compliance with the rule. At the end of the week, review your journal to measure discipline, not just P&L, because profits can fluctuate, but discipline is always under your control. Judge yourself by execution, not outcome. That's how you grow. Now let's address a common fear. What if I move my stop to 1 point and the market whipsaws me out, only to then run further in my favor? Every trader has experienced this, and it's frustrating. But remember, the rule is not about capturing every possible dollar, it's about eliminating the most painful scenario, turning a winning trade into a loser. Yes, sometimes you'll get stopped early and watch price keep going. But over the long run, the consistency of protecting profit will outweigh the pain of missing a few extended runs. And if you want to capture more, you can scale out or trail stops as I explained earlier. The principle never changes: protect first, pursue growth second. Another tip: treat small wins as trophies. Don't dismiss them. A 1-point win may not feel glamorous, but compounded across hundreds of trades, it builds equity and confidence. Think about casino operators. They don't need to win big once, they need to win small consistently, because over time the math takes care of the profits. You are the house when you trade with discipline. The gambler loses, the house wins. Your action plan is about becoming the house. If you struggle with discipline, make the stakes real. For example, put $1 in a jar every time you fail to move your stop at 1 point. At the end of the week, donate that money to charity. The pain of losing money to your own undisciplined behavior will train your brain faster than lectures ever could. Behavior change is about consequence. Reward yourself when you comply, punish yourself when you don't, and soon your brain will align with your plan. To apply this rule today, you don't need to wait for perfect conditions. Open your platform, set your charts, and commit to one simple practice on every trade. The moment you're up by your defined point, move the stop. Even if it's just on demo at first, drill it in. Don't wait for tomorrow. The only way to change your trading is to take immediate action, not someday action. Your routine is simple. Prepare with the right mindset, execute with the checklist, journal for discipline, and review for growth. Do this daily and you'll notice something powerful. Your emotions calm down. You stop feeling desperate to make it big. You stop fearing reversals. You stop chasing losses. Why? Because you know deep down that you're no longer giving back what's yours, and that sense of control is priceless. It doesn't just improve your trading, it improves your life. So here's your challenge for the next 30 days. Apply the 1-point stop-loss rule without exception. Journal every trade. Score yourself not by profit, but by compliance. If you follow the plan, the profits will come naturally. This is how real traders grow, not by chasing jackpots, but by building habits that stack small edges until they become unshakable confidence. You don't need 100 strategies, you need one rule, executed with discipline, every single day. That's your action plan. Never again watching your hard-earned profits vanish into thin air. Never again sitting in front of your screen with that sinking feeling, watching green turn into red, asking yourself why you didn't protect what was already yours. From this day forward, you never have to feel that pain again, because you now hold in your hands a rule so simple, yet so powerful, that it can become the foundation of your trading discipline, the 1-point stop-loss rule. This is not just another trading tactic. This is your shield, your line in the sand, your declaration that once the market gives you profit, you refuse to let it take it back. Think about what that means for your future. No more roller coaster emotions. No more nights lying awake replaying trades in your head. No more self-doubt that eats away at your confidence. Instead, you build a routine where discipline isn't a punishment, it's your freedom. You become the trader who doesn't panic when the market whipsaws because your rule is in place. You become the trader who doesn't sabotage their own account with greed or hesitation because you've created a system that protects you from yourself. That is real power. And here's the truth. This isn't just about protecting money. It's about protecting your mindset. Every time you stick to the 1-point stop-loss rule, you're training your brain to value consistency over gambling, discipline over hope, process over emotion. You're rewiring yourself into the type of trader who lasts, who grows, who thrives no matter what market they step into. This rule is your teacher, your coach, your anchor. It will not make you rich overnight, but it will keep you in the game long enough to win. And staying in the game, that's how traders become legends. So ask yourself right now, how many times in your trading journey have you given back profits simply because you didn't lock them in? How many times have you sat there thinking, if only I had just protected what I already had? Those moments don't have to repeat. That version of you doesn't have to exist anymore. From today, you draw a line. From today, you protect what's yours. Because your profits are not donations to the market. They are not gifts to give back. They are yours. You earned them. And if you don't respect them, the market will gladly take them away. Here's my challenge to you, starting with your very next trade: apply this rule. Even if it's on demo, even if it's with the smallest position size. The goal isn't the dollar amount, it's the discipline. Feel what it's like to move your stop to lock in profit the moment you're up. Feel the shift inside you when you realize you can no longer lose on that trade. That feeling of safety, of control, of confidence will change the way you trade forever. The more you repeat it, the more natural it becomes. Soon, it won't even feel like a strategy. It will feel like second nature. And when it becomes second nature, that's when you become unstoppable. Because here's the ultimate truth: trading isn't about making money today. It's about building a system that allows you to make money for the rest of your life. The 1-point stop-loss rule is one piece of that system. It's simple, it's clear, and it's effective. Don't let its simplicity fool you. Greatness in trading doesn't come from complexity, it comes from mastery of the basics. And this one basic, if applied consistently, can save you from the single biggest tragedy in trading: watching your own profits slip away. So let this be your final takeaway: never give back profits again. You have the tool, you have the knowledge. Now all that's left is action. Don't just watch another video, don't just nod along and agree. Put it into practice. The market rewards action, not intention. Open your platform, set your rule, and stick to it. Test it, trust it. Train yourself with it until it becomes who you are. And one day, not far from now, you'll look back and realize this was the turning point. The moment you stopped being reckless and started being consistent. The moment you shifted from chasing wins to protecting your future. Your discipline is your freedom. Your rule is your power. And your profits, once they're yours, they stay yours. That is the mindset of a professional trader. That is the identity you are building right now. So go out there, apply the 1-point stop-loss rule, and let the market know from this day forward: I protect what's mine. Because your profits are yours. Don't let the market take them back.